All right, welcome back. This is the Something Venture podcast. I'm Kent Lindstrom. I am your host. My guest today is Arie Tamaseb. How are you doing?
I'm doing fine, Kent. How are you?
Well, thank you so much for doing this. Arie has one of those kind of resumes. You've done a lot. Biomedical engineering at Imperial College in London, Stanford Graduate School of Business, done research in the fields of neuroscience. Here it is on and on. Multiple publications. His work's been featured in the BBC, Guardian, Forbes, and he is a partner at the venture capital firm DCVC. And in his spare time, has managed to write a book called Super Founders, which is just a fascinating book. It's so good to have you here.
Thank you, Ken. It's you're flattering me.
Well, you did the work. I just have to talk about it. So so DCVC. I mean, I can roughly explain what that is. This is an incredible venture capital firm. It was like this tiny fund not many years ago, and all of a sudden, and it invests, I think, in hard tech, and all of a sudden it's like a bigger fund and a bigger fund, and all of a sudden out of nowhere, DCVC is like a $2 billion fund. It's insane.
Yeah. I think over the past 10 years, the fund has grown, and now we have, as you say, over $2 billion under management, and I think maybe 10, 14, billion dollar companies that we have, big positions in, and things have been well.
It's just crazy. So how do you, what's your path to becoming there's not that many venture capitalists really in the world. You're at one of the very few $1 billion venture firms. What's your, before we talk about the book, what's your path? Like what goes on, in your, where does it all start for you, by the way? Like you're in London and now you're here. Like what was the?
For sure. Yeah. So I was an entrepreneur. I've founded companies before. As a young guy, started, companies and grew them to, millions of dollars in revenues and teams of, 40, 50 people. And I think as my next act, I was thinking, what is an interesting path, career path for me? And venture seemed like a interesting way to see what's happening in the world. So I think that the book, I started, writing. I was active on Medium and writing blog posts for a long while, and that's actually how I got into VC and venture. And some of the articles that I wrote back in 2015, 16, 17, those were some of the things that the other partners at DCVC were interested in, and how I joined this firm.
And so they called you up and said, "We like your stuff. Let's meet."
Right. Yeah. I mean, that was the start of the conversation. And that was, to be honest, a lot of my connections and the people I know in the venture world came from the things that I wrote, and they started conversations. So it's definitely a scalable way to network.
Yeah, that's interesting. Yeah, it's funny. People always ask how you get into VC, and there's, the classic route. Your dad was a VC, or your buddy at Stanford is a venture capitalist, and you started a firm. But the other paths are always fat, and a lot of times it's a writer, sometimes it's a lawyer. There's a lot of kind of crazy paths into it.
Yeah, I mean, I got into it via Twitter, I guess. So it was first a direct Twitter message with Matt Hocko that got me into venture.
A Twitter message with Matt Hocko is the start of many interesting things. So you write a book, and the book is called Super Founders: What Data Reveals About Billion-Dollar Startups. And here's why I find this interesting: is that there's been a thing in the last maybe 10 to 15 years. People have always started companies, and it's always been amazing that they create wealth and they get rich, and the company changes the world. But in the past 10 years, the magnitude of that thing has just increased massively. Josh Koppelman of First Round recently posted something where he took a company public. It was a huge success, and it was like $130 million valuation. And he's like, today, that's a Series A that I invest in. And so when you say billion-dollar startups, it is the fact that companies, Facebook as a startup, Airbnb, Uber, are worth tens and hundreds of billions of dollars and transform the planet, how people stay in other people's homes, how people, get around in terms of transportation. So what types of people and what factors are that go into creating billion-dollar startups is actually a pretty interesting topic. What is it that kind of made you say, I need to sit down and really look at look at the data, because you looked at a lot of hours, a lot of data here.
I did. I mean, first and foremost, I wanted to be a better venture capitalist. And I thought to be a better VC, I need to, and as you mentioned, I've published papers before. I was a science person. I used to go to conferences and publish in journal papers. And it a little bit bogged me down that a lot of lessons in venture and a lot of stories and narratives in the general entrepreneurship and startup ecosystem are based on narratives, are based on single anecdotes. Even the most successful venture capitalists, maybe sit on the board of $5 billion companies in their lifetime, and nobody has seen it all. And there's so many successful companies, and there's so many more failed companies that nobody has seen it all. So I thought, a data-driven study into understanding what was actually different between these companies would make my job easier. And on the way, I found out there's a lot of stereotypes, and the reason I ended up writing the book was to break some of those stereotypes. So yeah, that was the initial reason, the story, and this data doesn't exist anywhere. It wasn't, as you mentioned, I think it took me a couple thousand hours. It took me 4 years, evenings, weekends. It's a manual data collection process. You can't just write an algo to go and do it, because you have to go back in the Internet Archives and see back in 2011 what was the market size for this, or how many competitors did this company have, or read interviews from back in 2008 and 2007. So it was a lot of judgmental work, that the work that as VCs we do, just doing it back in the time and trying to understand how these companies looked. And it actually involved a lot of cold emailing, and just asking those founders, is this true or not? Can you confirm this or not? So the data collection took 4 years. It was a massive undertaking, and I'm glad we finally have this and we're publishing results.
Well, we'll talk about some of the specifics, but what's interesting is venture capitalists, you say there's no data. Venture capitalists have ideas about who makes and who doesn't make a good entrepreneur. They have that before your book without data, and they invest on that hundreds of millions of dollars. I mean, that seems like a crazy idea, that they're
billions of dollars. Yeah,
billions of dollars. They're like, well, I'm not going to invest in this company because it's not the thing I'm looking for. Which, here's the classic one: it's Mark Zuckerberg. It's a young guy, Harvard, maybe Stanford, drops out. Like, that's kind of the classic image. And if you're a woman, older, not at Harvard, I went to Northwestern, and that's not even on the cool list. For being a founder, being a venture capitalist, there's like 10 of us in Silicon Valley. We'll talk about some of the specifics, but was there like as this data, thousands of data points across 63 or 65 factors, is there a pattern that you saw? What did you find?
Yeah, there's a lot of patterns that I saw, and a lot of patterns that I saw that does not correlate with success, and we can dive in. But before that, I don't think I'm saying VCs are necessarily doing this wrong. I think it's great that every VC has a thesis. Like, we need that. I think what we need, one, is the diversity of thought and thinking at individual level. I feel like problems become and biases exist because everybody thinks like each other, and that's where we strengthen some biases. So if each investor has their own thesis, that's good. That's our job, and as long as we're different, we're good. And two, I don't necessarily think a lot of these biases come from VC. Actually, professional investors don't have as much bias as maybe the media, or what makes it into the popular lexicon of entrepreneurship. I think part of the reason is what makes for a good story. So there's this narrative bias that the stories that the first time entrepreneurs hear are very different from the companies that get funded in Silicon Valley. And there's a disconnect between these two, and what you hear and what you see is the Social Network movie, or you hear about Bill Gates, and every interview, even 2021, every interview is about how this 21-year-old college dropout started this and this company, and not actually talking about what the company does, because they make for the story. Or how another myth that I break in the book is solving personal problems. That every interview starts from I had this problem for 2 decades. My parents had it, and I did the research. It's a stereotype. You don't need to solve a personal problem.
Right.
It's like people try to make up some stories to, make it into the publicity, and some stories, go around, but it's not actually, backed by data. So we can dive into some of them. We can start with the things that I found that doesn't matter. Number one, age. Age was not correlated with success. You can be young, you can be old. It doesn't increase or decrease your chances of success. And we see two different sides of this. There's this famous Harvard Business Review article that says founders who are 45 years old or older are more successful, which at least my study says that's wrong. And then we have a lot of investors that all they do is go to Stanford campus and try to source companies, which basically means I'm sourcing 21-year-olds. And that's great if one person or one VC has that thesis, but it's not great if every VC has that thesis. So that's one on age. I talked about the personal problem thing. Family members, a lot of investors have a bias into, your two brothers starting this company. I don't like this. This doesn't look like a venture play to me. Again, that doesn't decrease your chances. The whole, education thing, education level, I found was not correlated with success. There's actually more PhDs than dropouts. There are, people with medical degrees, law degrees. There was this famous debate, about MBAs. I think this is a thing now on VC Twitter for the past couple of years that, should you do an MBA or should you not? And I think there's been different types of biases over years. 21% of all unicorns had an MBA CEO. And 22% of all companies that were invested in and raised a minimum of $3 million of funding had an MBA. So it kind of shows like, there's no difference in, and I look at the whole education and do a lot of, statistical analysis on it. So, having or not having an MBA is not correlated with that success. But some people have a bias against them. It's like, you don't know what you're doing if you went to get a degree about it. And some other people have a bias on the other end and basically say, you need to have a business savvy or you need to have that sort of background to go in. The ranking of the school did have an impact. So, it's fair to say people who went to, Harvard and Stanford and MIT, they are more likely to end up building billion-dollar companies. However, when you look at the full distribution, you see that, there's as many founders of billion-dollar companies who went to schools that were not in the top 100 as those that went to top 10 schools. So it's a distribution. Obviously, if 1/3 of all unicorns are started by those top 10 schools, it shows they're more likely. But also we need to understand, there's this 65% that did not go to top 10 schools. Then there's a lot of things on the competition or the market dynamics. I think a lot of startups are trying to say, we don't have any competition. Turns out 85% of unicorns had competition when they started. Like they were competing with somebody, and 55% of them, they were competing with big, large incumbent companies. And when I compared the two groups, and I'm not sure if we went through it. So one group that I have is unicorns. The second group that I have, which is my baseline, is a randomly selected group of companies that raised a minimum of $3 million in venture funding. And throughout the book, I compared these two groups. Basically, what's a typical startup look like? What the billion-dollar startup looks like? And when you compare this, actually the companies that competed with these large, big incumbents, they were more likely to succeed. They were more likely to succeed than startups that competed with other startups. And the worst case is if it was a startup competing with another highly funded startup. Like if you've raised $3 million and there's another company 6 months ahead of you that's raised 20 million, you're less likely to succeed in that market if you're just copying what they're doing. So there's a bunch of things in these, categories and market dynamics. I think a lot of people talk about market creation. Like we need to invest in companies that create new markets. These are white spaces. Turns out 70% of unicorns did not create a new market. They were just competing for share in an existing market. And some people would think, but the ones that create a new market, they end up becoming larger companies like Coinbase. Again, turns out that's not, like on average, the companies that competed for share were larger outcomes than companies that created new market categories. And I think like literally before the first chapter of the book, I go into, correlation is not causation and talk about the statistics of this. And I think the goal of the book is not to say you should do this or not. It's to try to stay away from these kind of proxy rules and try to stay away from these heuristics that kind of some investors or some founders or even mainly people around the ecosystem. I've seen less and less of that bias inside the, in circles of, top tech firms and VC funds, and more of that into the, people around the ecosystem. And the goal of the book is to kind of try to dispel those myths and stereotypes.
Yeah, it's the narrative bias is really interesting, that people tell stories such that you think your probability of succeeding in a startup is so high because you think the whole world is just, Travis Kalanick, Mark Zuckerberg. And you also forget about the businesses. So, Mark Zuckerberg is an interesting example, right? He was, yes, Harvard male, dropout, et cetera. People didn't invest. If you watch a video of Mark Zuckerberg back in the day, he was drinking out of a red Solo cup and mumbling. Like, you forget Facebook was growing at this insanely phenomenal rate that no one had ever seen. Mark Zuckerberg was the guy attached to it. But if Mark Zuckerberg had a company, if he'd walked in with Facebook on a whiteboard with no results, no, he wasn't like an obvious guy. So the story now, of course, this young dropout from Harvard, and hey, wasn't there another young dropout named Bill Gates? Becomes such a thing that then you get the VCs looking for the young white guy for a while.
Right. Yes. Yeah. And, it turns out this is a specific stereotype that you talk about. That's 4% of all unicorns. So there's another 96% that, to be honest, investors are investing in, but it's just like less talked about.
Yeah. What do you make of the sort of, how would you sort out entrepreneurs who are building businesses that aren't billions of, like, you meet an entrepreneur and you go, God, this guy's going to build an $80 million business and he's going to sell it, she's going to sell it, and they're going to make $30 million, and that's great. So success, but not a good venture outcome. Is there a way to kind of tease that out of the data, or is that a little too, too precise?
Yeah, that's a great question. Look, when I went, when I changed the outcome level, like from 1 billion to 5 billion and 10 billion, I did not see that much difference in what the data was showing. So it seems like these trends are, either companies kind of die or they become successful. And obviously the case that you're talking about exists, happens a lot of times. And I think what is needed there is a different type of financing. Obviously we know why those kind of companies are not interesting to venture investors, and I talk about the math in the book. So founders get a better sense of why even a $300 million fund needs a $2 billion exit to move the needle for it. But a lot of entrepreneurs, or like first time entrepreneurs, may not understand the math behind it. They say, I'm 5xing your money, why don't you invest in me? And
right.
So I think that there is a need for a different type of financing for these sorts of companies. And I think one solution is smaller funds. I think we are all going towards larger and larger funds, but there's merit to smaller funds that return a much larger multiple of the capital invested.
Well, certainly at DCVC, you are working with a fairly large, a large amount of capital to invest.
Of course. And I think part of that is, we are a deep tech firm. So, if you're building a nuclear fission company or you're building the next generation of mining technologies, these are projects that require hundreds of millions of dollars of financing. Right. So I think for a deep tech firm like us, we need that sort of money to continue supporting these companies when they hit the valley of death.
Yeah. What about companies over time? There's a couple concepts. One is, and I feel like maybe I've done this a little bit, where an entrepreneur persists on an idea. The balance between persisting on an idea, saying, look, I'm going to walk through glass and keep going. And then the point where, it's just not working. And it's not, there's no shame in stopping. It just, this one didn't work. Most of them didn't work. And then in there's kind of a concept of pivots where people either adjust their idea or sometimes really just create brand new ideas.
Yeah. So, I think when we look at these billion-dollar companies, the pivots happen very common. And sometimes they are, after the company has been formed and maybe it's 2 years, 3 years, 4 years into the business. And a lot of cases, these are before the starting of the idea. And one thing I normally, try to talk to founders about, or people who want to start a company, that, you need to think about this as a 10-year project. And, if you're committing your life to a 10-year project, you have to spend maybe a year or two just on the idea. And, before committing yourself, before maybe quitting your job or like, doing whatever is necessary to go out there, um, just think deeply about that idea. And, I think the data shows you don't need to come from that industry. That's another myth. 70% of consumer tech unicorns and 60% of enterprise tech unicorns had the founding CEO did not come from that industry. They had an average of 11 years of work experience, but they didn't come from that industry. But they knew a lot more about that specific problem they're going after than anybody else, in that space. So they took a lot of time learning about a specific problem more than anybody else. And if they see, this may not work, they move to another idea, to another idea. And a lot of these successful entrepreneurs, they change that idea. I wouldn't call this a pivot. This is before there's a company to pivot. You just change that idea, noodle on the idea until you come up with the last one. And what normally happens is when these successful entrepreneurs end up interviewing, or if we hear the stories, we just hear the last step. And a lot of entrepreneurs think, the best idea is something that just like pops in my head one night and I need to pursue that, rather than, all these best entrepreneurs just went through the past, just like try talking to the customers, tried learning more, tried pre-selling this until they found, something's clicking, something is working out, and I have a passion for this customer type and going after that.
It's, I got to ask you about the kind of hot topic right now. What about geography? As everyone declares Silicon Valley being over, Miami is the future.
Yeah, I mean, one part of this is this data is not necessarily predictive, right? I think there's been a break. There's been a tectonic shift that's happened during this pandemic with the shift to remote work and distributed work, that I'm not necessarily sure what what the study said, in the before necessarily applies to the future. But summarizing the data showed the companies that were based in Silicon Valley, they were more likely to become billion-dollar companies than any other geography. However, 50% of unicorns in the US were started in Silicon Valley. The other half were started in other tech hubs, LA, New York, Boston, the typical tech hubs that we know, and a bunch of, companies. I interviewed Rachel Carson of Guild Education in the book, and she moved, like she was a Stanford MBA. She was living here, and they moved out to Denver to start a company. And she goes about, what was the thought process there and what was the fight with the VCs about doing that. And it's a successful company and it's not in a traditional tech hub. So I think this can happen, and I see a lot of distributed teams and distributed work happening. And I'm happy to see talent being distributed in different places. But what was true is companies that were in Silicon Valley, they were more likely to succeed and become billion-dollar companies, no questions.
I mean, and there is something I've talked to a couple of people about. Mark Andreessen says that you can start a great company anywhere, but there is something to Silicon Valley, and that there is a capital base, a knowledge base. Traditionally, there's been a base of the right kind of engineers. There's the education system that, there is something to that, and the painters and the Renaissance all hang out in the same place. They don't come from nowhere. And Brad Feld says that Brad Feld's idea is the opposite. He's the guy who's like, oh, no, the startups can bloom anywhere. But even Brad has an idea that it is a limited number of cities. It's Singapore, Austin, Miami. It's not Davenport, Iowa. And as I say that, somebody's going to start a billion-dollar company probably in Davenport, Iowa. So
for sure. Yeah. So I think a big part of that comes to, how relevant distributed work would be. I feel like, and I think at the end of the day, it comes down to networking. If we can crack the code of networking while not being present, and like real networking, creating like a real relationship, working professional relationship with someone else, while not living around the same place, and these kind of serendipitous social, gatherings or social things happening around it that strengthens those kind of relationships over the long run. If that happens, then I don't necessarily see why geography would be relevant. But until then, I think there's some truth to this, that where concentration always works and happens, and especially I think on the exec level, it might be possible to hire engineers anywhere, but there's some stuff that you need to do with the execs of the team that might need some element of being in person or some level of concentration. So I think there would be, and I think that's a bad thing to some extent, because it might make things a little bit harder for jumping through the ladder for a junior employee to become an exec, because of this kind of difference between who gets to work remote and who has to come to the office.
Yeah.
I actually see at one point it would be a privilege to come to the office, and only the execs would be allowed to come in, and I think that's a bad thing, but I see that happening.
Yeah, I think I'd be curious to see what your guess is on the future of offices, but there is the issue of, people, senior executives in the Hamptons. I talked to an investment banker about this. The senior executive in the Hamptons is like, hey, this is great. A 25-year-old in New York in a 3-bedroom apartment who wants to go to the office and meet their future, husband or wife, it's not an advantage working at home for them.
Absolutely. Or anybody who wants to change jobs or jump through careers. Like, I can't believe how I would have done it if this was the situation and everything should have been remote and no physical events to network. So I hope these things come back. But also there's so many more people now in tech and startup and entrepreneurship. There's a lot of VCs. There's a lot of people who have been in the ecosystem, that I think there's just more people, and we can create these circles and limited concentration in other geographies as well. Yeah. That's a good thing.
I'll ask you another specific one, and then we wrap up with a couple general things. But another Mark Andreessen thing is this concept of timing, like when you have your great idea. GeoCities. I had David Bennett on. Pretty close to being a social network, but maybe 5 years. Or Pets.com was a 1999 failure, but everyone's ordering their pet food on Chewy today.
Right.
What about just, hey, great idea, you should have done it 2 years later, 3 years earlier?
Yeah, I think I start that chapter. I have a whole chapter on market timing, and it starts with Mark Andreessen's quote on every crazy person that comes here with a good idea, that will happen someday. The question is when. When I looked into the data, 70% of billion-dollar companies were recycled ideas. And that's a staggering number. Only 30% were first time that this idea was being tried. Everything else was tried before. And this doesn't necessarily mean that they had competition. Like, I talked to Tony Fadell, who was at General Magic in 1995, and then he started, the iPod and then iPhone and stuff in 2005 and 2007. And in the middle as well, he went to another company to do it. So he saw 3 times, he executed on the same idea 3 times, and it worked the 3rd time. And a bunch of others worked on it at different times as well. The main thing that I found was it's how close you are to an inflection point, to where the tailwinds happen. And obviously there's technological shifts that enable things like the iPhone and Uber. There's time shifts. There's a lot of regulation shift. In the book, I talk with Mario of Oscar Health, which was basically, the tailwind there was the ACA had just been approved and enacted. That created this marketplace for individual health insurance. Or Plaid, this great company in the APIs for financial technologies. What enabled a company like Plaid was the Dodd-Frank Wall Street Reform Act, which mandated banks to give electronic access if a customer wants that given to another company. So there's a bunch of these regulations. Like, for example, I think there's a price transparency regulation coming to healthcare now. I think that would create $1 or $2 billion companies, just in the way that mandate opens access to new source of data. So I think it's being close to these sort of inflection points, being maybe a little bit early, that is one of the best signs for founders to go for. It's the old and tried question of why now.
Yeah. Well, so now that you've thought so deeply about this topic, you've obviously literally written the book. What do you think? Take a great investor. I think Elad Gil, I think you mentioned him in your book,
Yes,
is a
yeah,
great
I
investor.
interviewed
Just
him.
just one after another hit. What do you think now is going on with people like that, that they're doing so well? Do they have an intuition for your data, or what do you think? They probably read your book now, but obviously didn't read it before.
Um, I have a little bit of a contrarian point on that. I think a lot of opportunities in venture are obvious. And at least at this point, it has become about who gets access and who doesn't. So this is a network effect and a brand effect in terms of venture. And in the book that I show, 60% of companies that ended up becoming billion-dollar companies had raised their seed or Series A funding from tier one brand name venture capital firms. And compare that to the random group, that was only, I think, 14%. And it's not necessarily causal. It's not like, because Sequoia invests in a company that becomes a billion-dollar company. It's normally the other way around. It's a great founder with a great idea and a good market, and they get access to money from Sequoia. And that's the same thing with angel investors and normally investors. That I think in a lot of these cases, the people who get successful is they get access to come in and invest alongside great firms and great teams. And obviously, they will have a higher chance of success because if a company has raised more money and from better firms, they will be more likely to end up becoming successful companies.
Yeah.
So it's about access. It's about who deserves who earns that access, and parts of it is reputation, is how they help these companies, and on and on. But the way Elad started his kind of investing career was because he had started companies and saw different things, and he had started helping out companies. He saw what problems he faced as a operator, and basically invested in the companies that were kind of solving those problems for him.
Yeah.
So
Well, where you sit at DCVC, you guys have a view probably as far into the future, doing deep tech as far into the future as anybody might. What areas are you just excite you, make you say like, oh my, crypto is just the future, or machine learning? Like, what is the thing that the rest of us should be, you really should pay attention to that, because that's a way bigger deal than you think.
yeah, that's a great question. So first, my thesis is founders, not industries. So I always talk about that I don't invest in the spaces or industries. I first pick the people, then I look at what they're doing. That's the way I even make a decision on taking a meeting or not. But going after that, I think obviously every venture capital firm is paying attention to the tech industry, all the infrastructure that goes into serving the tech ecosystem, and that's a great market. But we have so many much larger markets that are not tech for tech. So tech for tech is big, but for example, I've invested in two companies in the mining efficiency, and this is not crypto mining. This is actually rare earth metals, cobalt, nickel, gold mining, these kind of stuff, and that's a $1.6 trillion annual market. That's like twice the size of whole tech, and there's like probably very few number of startups there. So it's great to back exceptional entrepreneurs who go and use now this technology to make mining more efficient and make it less environmentally detrimental. There is textile industry. There is a lot in manufacturing, in construction. So I like to go after these massive old industries, chemicals, materials, cement industry, that are each of them are much bigger than the whole tech industry, and there hasn't been historically much happening there with tech. And one big problem there is the sales cycle. There's a lot of hard things about these industries, but if something works, they can own a whole massive market. They can be the next Rio Tinto. They can be the next massive chemical company, and these are exceptional category making company, or life changing companies.
Do you like it being a VC after having been a sort of a founder and a builder?
Yeah, I love it. It's a privilege. I think we get more than what we deserve. The entrepreneurs are taking the actual risk, putting their livelihood on the line, and we sit on this capital and we end up deciding to allocate what future gets built. So I think we need to be a little bit more responsible with how literally VCs are shaping part of the future of what technologies, what industries would get developed, and what type of people, what type of backgrounds get funding and get built in the future. So I think we need to be more responsible with better understanding our own biases and better understanding how we are impacting the world, because we've been privileged to be given this much capital. That means a lot to a lot of people.
Yeah. Well, ending on the book, now that you've thought so deeply, written the book, how do you think it will make you different, better as a venture capitalist?
Yeah,
Or
so
anyone who reads the book too, of course.
of course, I think of it in two ways. Number one is to not let certain biases that I have, or any investor has, or even any founder has, to come in the way of their backing an exceptional team, because they think, but this problem is like this, but this founding team, like better understanding the characteristics behind a founder and the characteristics behind an idea than the proxy rules around, these are two brothers, I never invest in that. You didn't go to this accelerator program, I will never invest in that. One is, and everybody has these cognitive biases. And I think it's helpful. It would make people better investors if they remove that. That's number one. Number two is, more data-driven and metrics-driven decision-making in investment. So as VCs, we can take certain shots. So if I'm comparing two different deals to invest, it definitely helps me to put them in context and say, this company, they boast the same valuation. Company A needs 3 miracles to happen, has 3 risk layers, and this company B needs 5 ways to go against the data and needs 5 miracles to happen. So, and maybe if I don't put it in metrics, I may choose company B, but when I put it on paper and look at the data, I choose company A. And obviously, there's a third way, which is the way I source and the way I find companies that's been changed.
Yeah. So how do people, thanks so much for doing this, but how do people, other than getting the books, is called Super Founders, What Data Reveals About $1 billion Startups. How else do people follow your thinking and track you down on Twitter, or what's the best way to?
Arie Tamaseb, Tamaseb, on LinkedIn and Twitter. That's where I talk about some of the findings from this book. Not every chart made its way into the book, and not every story and interview made its way into the book. So I will be publishing some of them on LinkedIn and Twitter. So I'll be glad if you follow.
All right. Well, thank you so much for doing this.
Of course. Thank you, Kent, and thank you for listening.
All right. Arie Tamaseb's been my guest. The book, Super Founders, What Data Reveals About $1 billion Startups. This is the Something Measured podcast. I'll talk to you next time.